Good morning and good afternoon. Thanks for joining us today for our February strategy update. My name is Keith Duran. I'm the Senior Vice President of Business Development, and we are joined as always with Jim Warner, who's the co-PM and Head of Research. Jim and I were just talking a little bit before the the start of the call, in which I'm really looking forward to this call today. There's a lot going on. We've had a run up in the technology and AI theme. We've had it fall. The economy is good, but there's negativity around the ROI of AI, even though there's been a massive step up in CapEx. This should introduce a little bit a shift in our thinking, and as well as we said last month that the crowded trade was coming, and it did, and we got out of the way of that. So Jim's going to talk about that. So there's a lot to cover. Before we begin, though, those that are new with us, Jim's going to cover a little bit in the first portion about the economic sort of backdrop, and then how that then shift to how those macroeconomics affect our themes and our positioning in the portfolio. So we encourage you, please ask questions simply by using the Q&A button at the bottom of the screen. And then as we go along, we'll address those questions at the end of Jim's prepared remarks. So without further ado, Jim, it's all yours.
Great. Thanks, Keith. And thank you to everybody who is on the call today. Let me share my screen as I normally do. Okay. So, we warned you about crowded trades last month, and that's exactly what we saw was kind of an implosion of about four different crowded trades, and I'll go through those. And of course, we will also talk about then how we are positioning now that that has happened. So let's get right into it. Just as a reminder, last month we said that our biggest worry, we're generally very upbeat and optimistic about 2026. The setup from an economic standpoint and from a market standpoint is quite good. Our biggest worry is that everybody agrees with us now, because we've been saying this now for months. And the thing that we were most concerned about were crowded trades. And that's in fact what happened. As the old adage goes, if you are sitting at a poker table and you don't know who the sucker is, you're the sucker. And that is in fact the problem with crowded trades, is that oftentimes they don't tell you when it's time to get off the trade. We actually had an inkling that this would happen. Obviously, we mentioned it last month, and we talked about it a bit the prior month as well. And so we did trim our exposure in some of these crowded trades that I'm about to go through. This raised the cash in both our Global Vigilance and Global Vigilance Tilt strategies. And you can see on the graphs below, just our cash allocation ticked up, and in particular in the Tilt model, where we had some really big winners that we decided to trim back. This is great because now we've seen some, pretty sizable pullbacks in some of these important themes, and this gives us tons of dry powder to now capitalize on it. So we're excited about that opportunity. So the first crowded trade implosion that I'll talk about is Bitcoin. So since peaking in November at $125,000, Bitcoin has now fallen basically almost in half. And the last 3 weeks has been a particular puke out, as essentially crowded trades were unwinding market wide. Bitcoin tends to be a barometer of risk taking, and so it works sort of inversely to the VIX, which is obviously a measure of volatility. So if volatility is dropping, you tend to see Bitcoin work higher and vice versa. You also see that it has a bit of a correlation to the dollar. So as the dollar weakens, you typically used to see you'd seen the Bitcoin actually has been weakening as well. That's actually a change in kind of the relationship that we've previously seen, where Bitcoin kind of worked as the dollar weakened. So just sort of an indication of how things have gotten a little bit haywire in the Bitcoin world. We exited our exposure to Bitcoin directly back in November. We still have a little bit of exposure in a Bitcoin miner, but that's really more of an AI data center play than a pure Bitcoin trade at this point. The second crowded trade that imploded, and this was probably really pretty acute a week ago last Friday, was the implosion in gold and silver. You can see from the chart below the orange dash line, that's silver, and it had an unbelievable day. I think it was like a 9 standard deviation type move in that one day. So silver's pulled back by basically about 34%. GDX, which is the gold miners, uh, pulled back 13, gold's down 8. And a lot of this was attributed to what was perceived to be a hawkish appointment of Warsh as the new Fed chair. And this has been interpreted based on his comments that he's made years ago about wanting to shrink the Fed's balance sheet. This is sort of this appointment has been interpreted as hawkish, and which has kind of thrown cold water on the whole dollar debasement trade that has been sort of in vogue for the better part of the last year. And that basically has been negative for the gold trade. Now, we trimmed our gold exposure, and we've been trimming it over the course of the last 6 months to a year, just because it's worked so well. We never owned silver, actually, but we still like gold here, even at the lower levels that we own it now. We still think that it's an excellent hedge. And frankly, I think the narrative on Warsh is probably too hawkish at this point. We think that. Certainly, President Trump's intention was not to bring in necessarily a hawkish individual. So, more to come on that, of course. The other crowded trade that has imploded has really been the Mag 7. And what I'll call really more specifically is the public LLMs. So the public companies that have that are building these large language AI models. It came out, and the vast majority of them gave their earnings, had their earnings calls last week. So Amazon, Google, Meta, Microsoft, Tesla, and every single one of them dramatically increased their CapEx guidance for 2026. In fact, if you add it all up, it's like $600 billion is going to be spent on primarily AI data centers and the chips that go in them, which is an incredible step up from expectations and actually caused virtually all of these stocks to trade off pretty significantly on their earnings calls. I think there is now a pretty reasonable debate on what the return is going to be on this CapEx spend. We still have exposure here. We actually backed off and lowered our exposure to Microsoft about a month or so ago. And we only have exposure still to Alphabet, and a little bit of Tesla in our tilt portfolio. And we're comfortable with those levels. But generally speaking, we've been sort of also in that camp of we know demand for AI is enormous. We have experimented enough with it on our own to know that the productivity enhancements are real. But this is a lot of money that's getting spent, and it certainly begs at least the question of whether the return from all these dollars will be worth it in the end. And frankly, it'll take several quarters to know whether that's actually true or not. Up until this point, I think the market has sort of been getting the hint here as well. Technically speaking, this is a chart of the Mag 7. It's not looking so great. It's looking pretty toppy. The Mag 7's put in a triple top, and from a real pure technical standpoint, it looks like the next leg could be down, not up. We'll have to see, and a lot of it is going to ride again on the question of whether or not the returns are really there for this massive level of CapEx spending. The last crowded trade that I'll talk about, and one where fortunately we don't have too much exposure to, is software. Software. This is actually a chart of the PE of the software sector within the S&P 500, and what you can see is that the valuations have really just cratered back down to levels we haven't seen since the big tech sell-off in 2022. And what has generally caused this sell-off over the last few weeks has been kind of a growing fear that AI is going to cannibalize a lot of these software business models. And I think the coup de main, not the coup de grace, because there was no grace involved in this killing, was the announcement last week by Anthropic when they released their new Claude 4.6 model that they could do all sorts of wonderful productivity enhancing things, including legal documents, et cetera, et cetera. And I think that really caused a pretty dramatic sell-off in these software names. Now, normally we start to salivate when we see things like this, but this really is a kind of catch a falling knife scenario, and it's really easy to get cut. To extend the analogy, when you're trying to pick up something, pick up a stock that's really gotten hit hard over fears that may or may not be justified. But certainly the narrative right now in the market is not healthy. And so while I imagine we will probably start to nibble around the edges and maybe buy a software stock or two, it probably isn't going to be a very aggressive move on our part until we start to see this broader narrative get a little bit more productive. So, but let's just level set, okay? The sky is not falling, right? So we had basically four really, really crowded trades. And when you get a really crowded trade, it doesn't take much to set it off, right? And they were set off. But let's step back. What do we have here? We still have a very solid economic backdrop. GDP is up. In fact, I'll get to that in a second, but it's great. Inflation is down. I'll get to that in a second as well. Payrolls are okay. In fact, we had another payroll print this morning that showed that 130,000 jobs were added last month. That's pretty impressive. Frankly, allays a number of concerns that folks had. And all of this probably means that interest rates are going to be lower, probably not higher. And so that's generally a good setup for the markets as well. Of course, we've talked in the past about fiscal stimulus is on its way. Big tax refunds are going to start hitting the economy in the next month or two. And of course, the bonus tax depreciation that we think is going to be a big deal. And then, as I talked about last month, we have a new theme in our portfolio about industrial resurgence, and in particular, non-data center industrial construction. And if you remember back about a year ago or so, there was a number of foreign companies that proposed investments in building new manufacturing and other types of facilities. Those promises were made about a year ago. We're starting to see the shovels hit the dirt, so to speak, this year, and so we've been broadening out our investments into that part of the economy, which frankly has been in a recession for the better part of the last 3 years. And so what you can see is this is all already starting to get reflected in the market itself. While the S&P is basically flat for the year, the Dow is up 4%. Energy names are up strong, up 19%. Basic materials up 14%. Industrials and transportation are also strong outperformers. And so this broadening theme is really important and something that we have been doing. As I mentioned, we've been shifting essentially from these, crowded areas of the market into these, very much not crowded areas in this kind of economic broadening theme. And so when you step back and you look, I mean, the Dow, while we've had all this crazy volatility in these particular areas that I mentioned, the Dow just hit 50,000, right? So it's up like 14% over the last year. A lot of people think when they think of the Dow, they think boring. Well, boring ain't so bad. And it's actually paying off. You can see that this is really just a beautiful up and to the right chart and really representative of how economic growth is now starting to spread into these more cyclical areas that have frankly been in recession now for several years. And so that's I think an exciting place to be looking for ideas. I mentioned some economic statistics. This is the chart on the left is the Atlanta Fed's GDP Now model, which is now forecasting around 4.2% GDP growth for the fourth quarter. That's phenomenal. And it looks like so that's great momentum going into 2026. And then the truflation gauge of inflation, which is, our favorite measure that looks at several million real-time inflation data points, we think is much better predictor of inflation than say what you get from the CPI or core PCE from the government. But you can see that it has fallen off a cliff and is down at around 0.7% inflation. So way lower than the Fed's 2% target and way lower than CPI or core PCE that is being, the numbers that the market focuses on. And what's causing this? Well, it's predominantly housing prices, as we've been predicting for months now. Housing prices in Truflation's gauge are falling 1%. Um, if you're in markets like Dallas, the number is much, much higher than that. And we think that that is going to continue to drag down inflation over the course of this year. So successful repositioning over the recent weeks, reduced Mag 7 exposure, reduced the AI data center exposure, rebalanced our gold, reduced our uranium, and then we added trucking and construction equipment. And we continue to add to AI, but really focused on the edge and physical AI. So think humanoids, think edge devices, think IoT. Those are areas that we still think the AI tsunami has yet to reach. And there are still some very, very attractive stocks out there to own in that world. So the market is broadening. This theme is great, and it is generating a lot of outperformance for us. So how are we capitalizing it? Well, I pretty much just touched on most of the things on this page. But the last thing I'll mention is that we are holding tight on our gold exposure. We are noodling on increasing our exposure to copper, maybe even add some silver. We'll see how that goes. And again, the software, it's a little too risky for us right now, but we're certainly spending time and rolling up our sleeves on that market in that particular sector. So real quick on performance update, and then we can get to your questions. I'm happy to announce that we are now 5 stars on Morningstar for our three major models or strategies: Global Vigilance Tilt, which is our most aggressive; Global Vigilance, which is a moderate profile and is essentially our flagship; and then our conservative version of Global Vigilance are all 5 stars on a 3-year basis. We're super proud of that. I think it's clearly an indication that not that our investment process is consistent at generating outperformance. As just to quickly go through each of these models, we had an exceptional 2025. I think, and we're up over 5% right now in our Global Vigilance moderate strategy. I keep coming back to numbers like our 10-year and our since inception numbers. I mean, to be generating 9 to 10% after fees for clients in a moderate risk strategy, I mean, that is great compounding of wealth. That really helps individuals achieve their financial goals, and that's really why we do this. Our tilt is having another great year thus far, up a little over 8%. We're extremely happy about that. Conservative also is off to a strong start. And so, one thing that if you paid attention to these numbers last month, they're not much below where they were a month ago when we last spoke to you. So we did a decent job of weathering this kind of storm or multiple crowded trade storms that have hit the market recently. And then, of course, strategic income is also off to a pretty darn good start. So, as far as the current themes, nothing new to report here. Our latest one that I mentioned last week and went through, or last month that I went through, is our industrial resurgence and construction theme. We're very excited about that. And let me stop there, Keith, and let's take some questions.
Super. Thanks, Jim. Before I get to the questions, I noticed in one of the slides it was talking about adding Bitcoin. I mean, how will we express that? That idea when we want to re-enter that through I mean, we had it through the data mining centers, but will we continue that, or is there something different?
Yeah, I mean, historically, we've approached it a couple different ways. You can do it either through the data through the Bitcoin miners
Yeah,
because they obviously mine the Bitcoin, and so there is a correlation there. You can go so far as to own Strategy, which we have in the past, which is essentially a Bitcoin treasury company. And now there's also, of course, a bunch of ETFs that we can also play. So there's a bunch of different ways that we can address this. And if we get to that point, we'll try to select the most attractive way to play it. But as I said earlier, it's tricky. Bitcoin is not like a standard asset. It does not have cash flows, so it's very difficult to value. It tends to be more, I think, of a voting machine on the amount of risk people are willing to take. And so at this point, it seems like there's a little bit of a pause in at least taking risk in that sort of manner. So at this point, we're okay standing pat and letting things develop.
gotcha. All right, here's your chance to ask any questions. Let me pull this up. I don't, there aren't, oh, hold on. We do have one. It says, do you guys like MLPs and natural gas?
Yeah, love it.
Love it.
Um, we own We own Williams. We own AMLP, which is an ETF with MLPs, and we own those pretty consistently across a lot of the strategies that we manage. Look, MLPs are terrific because really they don't have much in the way of underlying exposure to the commodity itself. It's really just a bunch of contracts, and so from a contractual standpoint, to be able to buy companies that generally also have very nice dividend yields that's a very attractive addition to most portfolios. I'd say specifically on natural gas. Again, we have a very large position in Cheniere Energy, which is the largest exporter in the world of liquefied natural gas. And there too is more of a contractually based business model as opposed to being exposed to the underlying commodity and the vagaries and swings that natural gas itself goes through. So so at this point, we don't really have any direct exposure to natural gas. It has been obviously very volatile recently, and I think we're pretty okay with that. We're very happy with our MLP trades, and we're very happy with Cheniere, and we're very happy with the nature of their business models at this point.
Super. We got another question, which kind of it says, "What do you think about fixed income and where's the opportunity?" We do spend a lot of time talking about equities, so
Yeah.
yeah.
Yeah, I mean, obviously, in our more conservative strategies, obviously in strategic income, as well as even in global vigilance, there's a decent amount of fixed income in these. And specifically, what we like in fixed income is really just two areas. We still are very much uh, tailored our exposure to the front end of the curve. We don't think there's going to be a huge amount of movement at the long end of the curve, but right now we just don't think you're getting paid enough for taking a lot of duration risk. But the other area that and I talked about this last month as well, that we really like is mortgage-backed securities. I think that mortgage-backed securities, they have basically, since the quantitative tightening was put in place by the Fed, the spreads on agency mortgage-backed securities, which have no credit risk, has been exceptionally wide relative to other fixed income instruments like investment grade bonds, for example. And so we have been very happy with that. We've seen the volatility decline, and so we have historically um, had pretty significant positions in mortgage REITs, which benefit from essentially tighter spreads and lower volatility. And so we're quite happy there. We also have a significant position in a mortgage-backed security mutual fund that we really love the strategy. It's kind of quirky, but it's again trying to take advantage of what we think are really attractive yields for really pretty limited if credit risk. So those are basically our two favorite areas of fixed income.
Yeah, that's great. It's awesome. There is another question. There seems to be growing pushback against data centers around the country, right, due to the electrical power constraints driving up prices for average residents, as well as consuming open spaces in the water, right, resources. So, is this showing any signs of having an impact of the data center growth? Is it yeah.
So far, I think so far the answer is no. Uh, there's certainly no stopping the large language model developers from spending on data centers. But yes, it is definitely a concern. We talked about this last month about how it was one of the headwinds that that was making us a little nervous, which is also translated into us actually reducing our exposure to AI data centers, which was a very big theme for us last year. And yeah, I think there's absolutely going to be some political pushback. This is an election year. So I think you're going to hear about this more and more. The electricity price thing is really, it's a pretty localized issue. It's particularly relevant in Northern Virginia. It's less so in, say, a deregulated state like Texas. But yeah, it's definitely going to be harder to get access to grids. And so you're seeing a lot of movement in by data centers to produce their own electricity, and that comes with its own set of challenges and whatnot. But I think we've spent a lot of time thinking about this issue. It is still the case that power is the core bottleneck. And yes, the political implications of potentially higher electricity prices is obviously very, very important. So yeah, I mean, in general, it's caused us to reduce our exposure to that theme in general.
Super. Why does Micron keep going up every day?
Well, yeah, it's been an amazing run for that stock. I mean, this is basically the mother of all supply and demand imbalances. Effectively, the high bandwidth memory chips that they make are in massive, massive demand by the folks like NVIDIA. And there's really two things going on. Effectively, they can't make enough. They're completely sold out. And in fact, there are other lower end memory, those prices are exploding. The DRAM stuff that goes into, phones and laptops, that's exploding because they've had to shift production capacity away from that stuff and towards the high bandwidth chips. So this is just this monumental surge in demand that frankly they don't have enough capacity to deal with. Now, the part of our thesis in owning it was that we expected that there was going to be an imbalance. Uh, as occurring. But what's incredible about this is while Micron is seeing an explosion in earnings, it really hasn't seen much of a expansion in its PE just yet. And so one of the reasons, and so historically speaking, Micron was viewed as kind of this very cyclical memory maker that, it definitely wasn't sexy. The volatility in earnings was enormous. And so it was typically always given a very low PE, kind of single digit PE. Part of our thesis is that the tailwinds for high bandwidth memory are such that they will go on for years potentially. And that if it goes on for years, it could eliminate this notion that Micron is this super cyclical business. And so you actually could see a re-rating at some point in the PE. And frankly, we haven't even seen that yet. So there could be a lot more runway for this stock to work.
That's awesome. That appears to be all of the questions that we have for the day. I would just like to say before we go that once this has been put through compliance, we will send the deck along with the video out to you. If there is anything that we can do in the meantime, please feel free to reach out to us anytime. Other than that, we thank you for spending time with us today, and we will see you again next month.
Thank
Thanks,
you
Jim.
all. Take care.